We decided today to raise the target rate for the federal funds rate by 1/4 percentage point, bringing it to 1.5 to 1 3/4%. This decision marks another step in the ongoing process of gradually scaling back monetary policy accommodation, a process that has been underway for several years now. Job gains averaged 240,000 per month over the past 3 months, well above the pace needed in the longer run to absorb new entrants into the labor force. The unemployment rate remained low in February at 4.1%, while the labor force participation rate moved higher. Over the past 4 years, the participation rate has remained roughly unchanged. That's a sign of improvement, given that the aging of our population is putting downward pressure on the participation rate, and we expect that the job market will remain strong. Based on the projections that committee participants submitted for this meeting, the median projection for the growth of inflation-adjusted GDP is 2.7% this year, 2.4% next year, and 2% in 2020, a bit above its estimated longer-run rate. The median projection for the unemployment rate stands at 3.8% in the fourth quarter of this year and runs at 3.6% over the next 2 years, almost a percentage point below the median estimate of its longer-run normal rate. Finally, the median inflation projection is 1.9% this year, 2% next year, and 2.1% in 2020. On the one hand, the risk would be that we wait too long and then we have to raise rates quickly, and that foreshortens the expansion. We don't want to do that. On the other side, if we raise rates too quickly, inflation then really doesn't get sustainably up to 2%, and that will hurt us going forward. We need that, and we need to make sure that inflation expectations are anchored at 2%. So we're trying to take that middle ground, and the committee continues to believe that the middle ground consists of further gradual increases in the federal funds rate as long as the economy is broadly on this path.